Stocks, ETFs, mutual funds. When should you use them in your portfolio? We go through all that today on this episode.
We hope you've been enjoying all the episodes from the Secure Your Retirement podcast. If you'd like to keep learning and receiving these episodes, then hit the subscribe button and turn on notifications by hitting the bell so you receive alerts when each episode comes out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to Secure Your Retirement podcast. Today, we're going to have I think, a really nice conversation, Merce, where we're going to talk a little bit about kind of some of the changes that is evolving with technology when it comes around investing. We just here recently were able to do, which we do every year, we do a rebalance, because basically after you go through a whole year of growth, or if you didn't have growth, you still need to rebalance your portfolios to make sure that all of your allocations are correct. And one of the things that we just did in our rebalance for the year was we really did a couple of things with a real specific purpose in mind, and that was to make sure that we were reducing any internal costs that we could reduce in the portfolio. So I think what would be good, Merce, is just kind of maybe talk a little bit about the history of where we've come from. We were talking about this just a few minutes ago, and just to set this up a little bit, you've got three main categories of what people know when it comes to investing in the stock market. You've got stocks, individual stocks. You have mutual funds, and a mutual fund is it's a company, and inside of that is a stockbroker. Then you got ETFs. They originally came out to be really passive index type ETFs, where they would track an index like the S&P 500, the NASDAQ, the Dow, technology, pharmaceuticals, all those different things that it would track. And then you now actually have what are called actively managed or strategic ETFs, where they have a particular strategy behind them. But sometimes people might ask the question, what's the difference, or why would somebody buy an individual stock versus an ETF versus a mutual fund? So I think that what you talked about earlier, Merce, was kind of an interesting way to think about it, and kind of the evolution around this. And maybe if you could just share that history with us, and just to kind of make sure that the listeners are on the same page.
Yeah. So I think if we go back in time and just think about the how people got into investing years and years ago, was you would turn on CNBC and you look at the ticker tape down below at the bottom of the TV, and you see all these stocks and the prices associated with them. And then you see all the people on the trade floor running around, and it's all revolving around stocks as investments. And so, most people started off investing with just buying stocks. And then maybe they start working with an advisor, and that advisor now is buying the stocks for them. And over time, what ended up, I think, happening is that while stocks are in general a great long-term investment, they can become inefficient if we don't have a good way to manage them and to manage the purpose or the strategy behind the stocks. And you would have some advisors that would be, stock pickers per se, or day traders or things like that. But as this world of needing investment guidance and investment help grew and grew and grew, the next iteration of investments that came around was really the mutual funds. I think the mutual funds came out of convenience. So that's the mutual fund company creating a fund, and inside of that fund, you've got a mutual fund manager, and you've got a lot of things that happen to create that fund and maintain that fund. But the underlying investment of that mutual fund in most cases is still the stocks that we know work well over a long period of time. And so mutual funds became a convenient way to get access to a whole bunch of stocks without having to manage a whole bunch of stocks. Well, as we started to look more and more into the mutual fund space, while they were working to a degree and providing that return and providing that simplicity, what the world started to realize and decide is that, well, the fund managers are a little bit pricey, and the mutual fund companies are for-profit companies, and they got to make their money and everything like that. So the underlying cost of being in a mutual fund started to get away from us, to where, there's some funds that we would see that were your internal cost, your expense ratios, your turnovers, all those different metrics for evaluating costs within a fund ended up being somewhere in the realm of, say, 1% to 3% in the earlier days, and that was rather expensive. And so the investing world started to say, well, what can we do next to alleviate some of this cost, but still maintain the convenience, and still make it easy entry to investing. And so that's where the ETF came into play, the exchange traded fund, which, like you said, was designed to be really a passive investment. So if you take away the mutual fund manager, you take away the mutual fund wrapper itself, and now you just create a vehicle that's basically a basket of stocks that has just the purpose of mimicking some type of strategy or index, but it's pretty passive. All of a sudden, the cost started to get lower. And if we can make it trade like a stock, and just have intraday pricing, unlike a mutual fund, which only trades at the end of the day and it doesn't move throughout the day. Now we've got more visibility into our investments because we can see it every single minute of the day. And we've cut our costs because we don't need that manager making special decisions or anything like that. We're just trying to mimic a passive index like the S&P 500. Well, that could be pretty beneficial. So ETFs really took off when they came into the world of investing, and they're still really important, I think, to the world of investing. But in this world of paying attention to fees, and we always get asked, how do we get paid, and how does another type of advisor get paid, and then how do the investments make their money, and all that stuff. In a world of trying to understand fees and fee suppression as well. Technology, I think, is doing a lot for us today to make our investments for the families that we serve even more efficient. So in this story so far, you've heard me talk about stocks, you've heard me talk about mutual funds, you've heard me talk about ETFs, exchange traded funds. In all three of those cases, the way that these all grow and earn and become an investment is their underlier is still the stocks that really started the stock market world. And so if it's tried and true that stocks work, and if we can manage stocks with convenience, well, now we can make it a very cost-effective type of investment strategy. And so that's where, with this rebalance that we've done here recently, have shifted towards. And the reason it's possible is because of technology. So today, for our, there's a handful of different strategies that we use, but for our core strategy, we wanted to resemble some element of an index that we want to track. For us, it's pretty close to the S&P 1500 is what we want to be resembling. The 1500 has 1500 stocks, but you don't need to have all of those to get the exposure of the index itself. So we have over time here transitioned out of the ETF world and into a stock indexing strategy. Well, how is this possible? And are we going in circles? Because now we're back to buying stocks again, where we're trying to get away from buying stocks. Well, because technology has made things so much more efficient, we're in a place where we can mimic an index with the underlying stocks, and we get rid of the ETF that still has to make money to stay in business, and we get rid of the mutual fund that had the mutual fund manager and the company itself that had to make its own revenue. And so now we can, make a very clean strategy towards mimicking some type of index as part of our overall philosophy around this growth bucket that we talk about quite a bit. So big picture, why would we go back to stocks? I think two things. One, technology has made it more efficient to be able to replicate an index. And then the other is, if we are able to do a strategy with stocks by itself, well, then we start to get more cost effective, and we get rid of some of those internal costs like expense ratios and turnovers and management fees and admin fees and things like that for a portion of the strategy. With that said, though, I still think there is a good case for having specialty types of investments like an exchange traded fund in your portfolio. So you want to talk a little bit about that, Radon, and maybe anything I missed on the stock piece?
No, I think you covered it really well. I do want to just reiterate, though, that when we talk about this idea of going toward this balanced or indexed approach on the stocks, that's just on a part of the portfolio. That's not the total portfolio. So we do have other parts of the portfolio that we will use other investments like ETFs. But why would we use ETFs there? Well, because again, ETFs really can be structured to handle certain strategies and to do those very, very efficiently. it's still extremely cost effective to use those vehicles for certain particular strategies. So you've always heard us talk about really a couple different elements of the portfolio. One, we call it our core strategy. What is a core strategy? A core strategy is where we're saying, hey, look, we are just trying to track the market. That's what we're trying to do. We're trying to expose ourselves to the market, make sure that we're getting the returns of the market. That's where we can use very effectively, very cost effectively, a diversified approach of stocks, individual stocks. We get rid of the underlying cost of the ETF. But then we've got that section that we've always talked about, which is called the tactical part of the portfolio. Tactical means we are going to want to make changes more rapid based on what's actually happening in today's market and to hedge ourselves against larger risk. For that part of the portfolio, we still are going to use exchange traded funds. And the reason why is because they can be structured to do this in a very, very cost efficient way. And so it still makes sense to do that. So, for example, we have a couple of different tactical strategies, but one of those is to hedge against risk. And so what that means is that we can have that part of the portfolio designed specifically that if we have a significant turn down in the market, we're not going to participate in all that turn down, right? So we are buying that part of the portfolio for that strategic purpose. We're doing it because we get good returns if we have upsides in the market, but we're protecting ourselves from significant downturn. And we're able to do that very, very cost effectively. If you remember, we've got a third part of the portfolio, private investments or alternative investments. Still, again, to get into that arena, buying an ETF or a fund is still the most efficient way to do that. In fact, it's kind of the only way to do that in a diversified approach. And so you'll still see in the portfolios that we're managing that we do have ETFs in there and funds in there. But the reality is anywhere we can utilize the strategy behind using individual stocks, we're going to do that because it cuts the cost down. So we get our portfolio operating very, very, very efficiently, and we're able to do it in a very, very strategic way. And so I just think we're excited because you are able to really have the best of both worlds. I will tell you, when you do this, though, you are going to see more positions in the portfolio because if I bought an ETF, I could buy one ETF that represents really 500 stocks if I want to, or 1,500 stocks if I want to. We just know we can do that with 50 to 60 stocks and get very good diversification. We are not trying to go out there and saying, hey, this is the best stock in the whole wide world, and we're buying this stock because we think it's got long-term growth. We're just mimicking an index or mimicking a strategy, and we could buy and get out of those or into those simply to track the index that we're trying to track. It has nothing to do with us coming out there and saying, hey, guys, we just bought Walmart today because we think Walmart's the best buy in the world. We might own Walmart. We might own Amazon. We might own different companies, by the way, that you already owned anyway if you were in a mutual fund or in an ETF. Sometimes we had a client said to us, yeah, well, I never knew I was in those stocks. Well, now I know. It's like taking the hood up and looking inside the ETF or looking inside the mutual fund, and I just get to see it all. And that can be very, very good because you're kind of seeing, hey, how are these companies doing as an individual part of the overall approach? Understanding that what we're trying to do is mimic that index or that strategy that we're trying to do. It's just with the technology we have today, there's just no better way to do it. If you're looking at trying to have a cost-effective portfolio, you want to do this. Now, however, if you had to go out there and pick off 50, 60 stocks yourself and manage it, that'd be a tremendous amount of work. And you would be doing nothing but looking at that all the time. This allows us to be able to do that and manage it very efficiently. So we're excited. We think it's a great way to go.
Yeah, I think big picture, because I talked to someone earlier today, and what I told him is that our philosophy on investing has not changed. The core, the tactical, the alternatives, this whole conversation of growth bucket and safety bucket, none of that has changed. But the world is evolving, and we want to try to stay ahead of it, especially as technology just gets better and better. So, yeah, are the tools in the tool belt getting? Are we changing some of those around a little bit? But the answer is yes. But the philosophy itself is still the same, and that's really what it is. So, I think if anyone has any questions or anything like that, we're always happy to handle them and have a conversation around, well, explain this part to me again. Why did you guys go into stock portfolios? And we're always happy to do that if you got questions.
Yeah, it's real easy to do. Just go to our website, pomwealth.net, go to the contact us page, reach out to us. We'd love to be able to have a conversation. We hope this has been helpful. We always enjoy bringing new concepts and new ideas out there to you. As always, we hope you have a great week. We'll talk to you again next Monday. If you would like to find more information about Peace of Mind Wealth Management, we invite you to visit our website at pomwealth.net. If you go to the contact page and contact us, we'll send you a free copy of our book, The Peace of Mind Pathway. It lays out our process from beginning to end. Please visit our website.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.